Initial public offerings, or IPOs, are some of the most talked about events in the financial markets. For the company, it's a momentous opportunity to raise capital from the public. And for retail investors like us, it's a rare chance to become a shareholder in a company right at the start of its public journey. But what determines the success of an IPO? One of the most important factors, often working quietly behind the scenes, is the presence of anchor investors. In this video, we'll understand who they are, why they matter, and how they influence market sentiment. So who exactly are anchor investors? In India, these are typically large institutional investors, such as mutual funds, foreign portfolio investors, insurance companies, and sovereign wealth funds. What makes them unique is that they are invited to invest in an IPO before it is open to the general public. These investors are allotted shares at a fixed price, decided by the company and its underwriters. This early participation helps create a sense of stability and signals market trust. The concept of anchor investors was introduced in India by SEBI, the Securities and Exchange Board of India, in 2009. The idea was simple yet powerful: to bring in trusted, credible institutions before the public issue opens. This move was aimed at boosting the confidence of retail investors and generating healthy demand right from the start. Anchor investors operate under specific rules. They must invest a minimum of rupees 10 crore in regular IPOs or rupees 1 crore in SME IPOs. They are given shares before the IPO opens to the public, and the company, along with its advisors, chooses which investors to allocate shares to. This process is not random or automatic. It's based on the company's judgment. The shares are given at a fixed price, and there's a lock-in period. 50% of the shares can't be sold for 30 days, and the remaining 50% shares for 90 days. So why are anchor investors so important? First, their participation builds trust. When credible institutions come on board, retail investors feel more confident about the IPO. Second, anchor investors bring in significant capital, helping stabilize the subscription levels. Finally, since they invest at a predetermined price, their entry helps set a benchmark for other investors and signals that the pricing is fair. Let's take the example of Zomato's IPO in 2021. Big names like BlackRock and Fidelity International participated as anchor investors. This created a wave of confidence among retail investors, many of whom were previously unsure. As a result, the IPO saw massive oversubscription and a strong listing. The presence of well-known anchor investors is often seen as a stamp of approval for an IPO. This not only builds trust, but also triggers media buzz. People start talking, news channels cover it, and soon there's a sense of FOMO, fear of missing out, among retail investors. Plus, knowing that these investors have done their due diligence reduces the perceived risk. Here are a few real-world examples. The LIC IPO, India's largest ever, saw major anchor investment from GIC Singapore and SBI Mutual Fund. The Nykaa IPO attracted global players like Abu Dhabi Investment Authority and T. Rowe Price. Even Paytm, despite its rocky post-listing journey, saw participation from BlackRock and CPPIB, which helped generate early hype. There are many benefits of having strong anchor investors. Their presence adds credibility to the IPO, encouraging both institutional and retail participation. It also encourages oversubscription, increasing overall demand. And most importantly, it helps other investors feel confident that the IPO is fairly valued. But it's not all positive. One key concern is the short lock-in period. After 30 days, anchor investors can start selling, which may cause price volatility. Also, there's the risk that retail investors over-rely on anchor participation and ignore the actual business fundamentals. That can be risky. So, what should retail investors do? Even if reputed anchor investors are on board, it's essential to do your own research. Start by understanding the company's business model, financials, and growth prospects. Read the red herring prospectus. It contains crucial info about risks and how the funds will be used. Lastly, look at the broader market conditions before jumping in. Anchor investors undoubtedly play a major role in IPOs by bringing in credibility, stability, and demand. But as retail investors, we shouldn't follow them blindly. Instead, use their participation as one data point and combine it with your own market research. Informed decisions always lead to smarter investments. If you found this video useful, don't forget to like, share, and subscribe. Ready to invest in an IPO? The first step is opening a trading and demat account. To be IPO ready, click the link in the description below. Happy IPO investing!